Right, everyone. It's a lesson. Never leave your seat. Someone's always going to stop you in your tracks and slow you down. Okay. Welcome to today's webinar. I think everyone's had a chance to read the risk warning at this stage. I'm going to switch slides to show us the title of the webinar, which is Trading Pullbacks. So this webinar is designed for people who've never encountered this concept before, and for those who have been toying with it but would like some bit more specifics on kind of the general concepts behind doing it and how to go about it. So I hope it's useful. Obviously, if there is something I'm missing, a question that you have, please feel free to contact me anytime with questions, and I'll either answer straight away or towards the end of the webinar. So the topics covered today: what is a pullback? Why would you actually trade them? A big one is how big will the pullback be? That will make more sense when I explain what it is, but it's kind of okay, so I think there's going to be a pullback, or I think there is a pullback taking place. When does it stop, and when does when can I jump in? Is obviously always the key one. And then once you think maybe the pullback has ended or is about to end, how do you actually enter on that pullback? How do you place the trade? How do you buy the dip or sell the bounce? Quick one on where to set stop losses. I haven't gone too in depth on that, but we can kind of play around on the charting platform a bit. We'll have some Q&A at the end if needed, but in general, I will be kind of demonstrating these ideas in live markets on the trading platform. So another bit of my grand artistry, demonstrating the general concept here. So pullbacks are any period in which the market is pulling back, hence the name, from the trend. And notice how I've put trend in bold and underlined, double emphasis there, because there can only be a pullback within a trending environment. So mistake number one when you're first trying this is trying to buy pullbacks within a trading range. Now, of course, a market may be trending and turn into a trading range, and when you're buying the pullback, that's nature of the beast. Market conditions change, you get stopped out on trades, or you maybe have a break even. The trend doesn't resume as you expected. That's all par for the course. But when there's a clear set sideways market taking place, do not go for a pullback strategy, because it is completely counter the intuition behind the idea. Just to explain it another way, there's a pullback taking place when the market is temporarily going the opposite way to the trend. So obviously in these two examples here, I've got an uptrend. These two pullbacks, pullback 1, pullback 2, are dips, right? The market's dipped and then rallies again, dips, rallies again. In the downtrend, it's trending downwards. You get a pullback 1, which is a bounce. And then you get the market drops again, you get another bounce, and you sell it. And so the general idea here is that the market's trending. We think it's going to keep trending, keep going up in an uptrend or down in a downtrend. But it's very nice if you can buy it at a nice little low spot within that uptrend, or sell it at a nice little high spot within that downtrend. I'll emphasize those ideas a little bit more in a minute. Right here, pros. You are trading with the trend. I'm a big fan of trending markets. When it comes to day trading, that's the main advantage we have, is that markets, in my opinion, aren't completely random. There are sustained periods in which markets trend, and that can give you an edge. Now, the nice thing about pullbacks is that you can buy low and sell high, still within the idea of trading a trend. So oftentimes, you get particularly the kind of professional trend followers, which tend to be kind of large futures trading firms. A lot of their strategies are very simple, and they kind of fit around the general idea of something like the market hits the highest it's been in 200 days. Often, obviously, there's lots of extra criteria added in there. And obviously, lots of times the market may hit its highest in 200 days, and that will be the highest it's been for a number of days. But if that is the case, they cut the losses quickly, and look for the next opportunity. And the idea being, well, it's the highest in 200 days, the environment's changing, it's high, and you buy high, and in the expectation that you can sell it even higher. Nice thing about pullback is that you don't necessarily have to buy high. You can buy slightly lower for the market to then move higher and you sell higher. So generally, when you are trading trends, you're sort of buying high, selling higher, selling low, selling lower. But this just mitigates that slightly. Now, for those of you who attended the breakouts webinar we did last week, we talked a little bit about false breakouts. If you haven't watched it, I recommend it. It's on YouTube at the moment. I think it's just called Trading Breakouts. Subscribe to the YouTube channel if you haven't done so already. The big issue with trading breakouts, you get these false breaks. So the market makes a new high. You think, oh, great, we're in a trend now. And then it just fades and the market heads back in the other direction. In fact, it was a false breakout. Buying the dip, you're not buying at the high. You're not selling at the low. You're actually waiting for that dip, that pullback first. So it avoids the whole concept of a false breakout. Now, the downside is that, unlike with the breakout, you're buying at the high as the market's moving higher. If it continues, you're into the trade. If you're waiting for the pullback may never happen. Or it pullbacks not quite as far as you think, or it pullbacks further than you think, and maybe you get stopped out, or at least you have a period of stress. So this is one of the key questions here. Oh, John, it's John saying it's suddenly cut out. Is everyone else still hearing me okay? Okay, getting confirmations elsewhere, John. Hopefully you can hear me again too now. If you can't, I'm hoping that you know to re-log in. But okay, I'm going to carry on. I'm assuming it's working. So this is just a very simplistic looking diagram here, obviously. So the idea being that this where I've drawn the line through is we've had a surge in the market. Okay, the market has developed into what we think is going to be a sustained trending environment. The market then has a big pullback candle, and we think, great, this is our chance to buy low within an uptrend and buy at a value area. But where does this pullback end? Does it only last one candle? Or does it, does it dip a little bit further, or how far does it dip? And obviously you can see quite simply here this idea that, if you'd bought on this first line, you'd definitely be into the trade, but there's a risk that maybe, depending on where your stop loss is, you get stopped out because the market does move further, or at least, as I said, you go through a little period of stress in which maybe you are tempted to exit the trade early because you see the market bobbling around and you're worried the trend is reversing. Or this bottom line, obviously the middle line, brilliant. You basically bought it at a perfect spot. Unfortunately, that's fairly rare, but it's very nice when it does happen. Or sort of option B, or sorry, option C or 3, if you like, is where you decided to buy on the dip down here, but the market never even gets there. That's that is one of the major downsides of trading pullbacks, and it's just something you basically have to live with. But you can reduce the chance of it happening somewhat, and we'll talk about that in a little bit. So, where will the pullback stop? That's the question. So, I've highlighted 5 places a pullback will typically end. This is not a complete list. You could probably add 100 items on here. Things like pivot points and things are very popular, but I've not chosen to discuss all of those. These, I think, are the key ones. So, I think the next step, let's see what my next slide is. It's looking at the trading platform, so let's do that. So I've just designated, and here's those same 5 points again. I've just designated the oil market because it just so happens it's been in it was quite recently in a decent trend. and there were a few kind of variations on pullbacks taking place there. It was a nice strong trend, but nonetheless this is basically the kind of environment where pullback trading can be very effective, and you can sort of highlight some of the different ways of doing it. So let's start with that. So you can see here that the first one on the list, support and resistance. This is particularly the case in the early parts of a trend. So you can see here that if I zoom out a bit, I mean it's a little bit difficult with the benefit. Obviously, you've got the benefit of hindsight here, of seeing this nice trend environment takes place. Obviously, at this point in time, you weren't too sure what's happening. But say, let's just give ourselves the benefit of doubt, and I actually think I did say something like this close to the time, that maybe we think somewhere along this point in time, this little period of correction is over, and we're the moving averages have switched into, you know, kind of trending mode. We seem to be breaking out of a consolidation or a sort of sideways lower movement, and we seem to be shifting into an uptrend. Let's just say that's our thought process. And so we're anticipating this trend ahead. You can see here that here was two areas of resistance. The market rallied up, pulled back. This little pullback here ended at this previous resistance level. The market then consolidated below that previous resistance level there. We had a kind of sideways period. It was again supported by a moving average, which I'll mention in a minute. But you can see the market then does break out, pulls back again to what, you know, you could talk about this area up here. It's kind of does work as well. You know, you have a jolt below it. If you don't include that previous spike, then actually the pullback works pretty nicely up here. So you can see how this little pullback that takes place here ends at an old resistance level, which becomes support. Same here. And then even during these consolidation phases, these kind of sideways movements within a trend, you can sort of use the old levels of support. So this particular level, you know, we saw a bit of price movement below it, and in fact it came back down to that old resistance. But you can see, generally speaking, that level kind of, with a few false breaks, kind of held. Oh man, getting hammered with messages as soon as the webinar starts. And then you can see again, it was this level that basically held as support again, and the market moved forward. So you can sort of see support and resistance working here as highlighting areas where the pullback might end. Now you'll also notice that say we had that as our support, you know, why didn't it quite end there? Well, actually it was 50, the round number, that actually pretty much called where that particular pullback ended. So always good to kind of combine a few of these concepts, and the one that I'll always try and involve somewhere in there in terms of where I'm choosing to buy in on a pullback will be, okay, where is a nearby round number? Because that's what the big boys use. They are not particularly technical for the most part, the big institutions. They have their reasons for trading, and they're just looking for, you know, for entry points, and generally not too specific entry points, not with multiple decimal places, just the big round figures. Some big bank says I want to buy in at 50, some big hedge fund says I want to buy in at 50, send their traders in to buy up the market around 50. So, you know, that obviously to some degree explains that 50 mark, and then equally you see this kind of bigger pullback over here. Well, where does that end? You know, you already kind of pre-guessed where I was coming on with this. It is indeed a combination really of that old resistance area which is there, which holds as support in this, well, it's like connecting to, there we go. You can see it kind of holds as little mini support there, and then again support holds again, and it's not quite the support level, actually it's the big round number that holds as the support level. So you can see there's kind of different factors that are all contributing to where these pullbacks end. Another nice one is the 50% retracement level. Now this is so what I wanted to talk about here was that you see I've got these little dots on the screen here. Don't be too confused. One thing I don't like about, so these dots are called fractals for those who aren't familiar. It's just a nice little way to kind of highlight where a swing point is. The one thing I don't like about the way our platform presents the fractals is that it actually touches the bottom of the candlestick, so you can't always see exactly where the bottom of the candle is, so if you've been a bit finicky. So I've just shifted it one to the right. So for those of you who are interested, the indicators I have on this, the indicators I have on the screen. Okay, where are we? So there's fractals under your object list. Click on fractals, and all I've done is I've just shifted it one period to the right. You can also shift it to the left if you chose, -1, for example. Shifted it to the right just so I can see where the low is on the candle. Okay, the reason I mention all this is that when I'm using a Fibonacci retracement or just the 50% level as an area for pullbacks, what I'm generally trying to focus on is just the immediate previous leg. So let's take this first leg high, for example. I mean, you've got to have some rules in place, right? And so this is the rule I employ. I'm not saying it's the only rule, but let's get rid of all these extra levels. I thought I'd already saved this. Apparently not. Okay. Snap prices, apply as default. Okay. I'll just refresh that for good measure. Oh, there we go. Got fighting for a minute there. So let's just add in 100. So you can see that you could, this little price surge has just happened, and we're up around here somewhere, and we're waiting for the pullback. You could draw it right from the bottom. And actually, when we're looking at this particular pullback area, and do you remember it ended at 50, and it's just above the moving average, and it's a little bit of a false break of that particular support, but it is these resistance areas. Here you see it's pretty nicely the 38% pullback in terms of Fibonacci's right here. But what's also nice is that if you go to the most recent leg, which you can see denoted by the fractal that I've got down there, it's actually very nicely the 61.8% Fibonacci pullback as well. And this tends to be the one that I focus on. If there's a larger move that that you see some correlation with, where a smaller pullback of a larger move matches up with a larger pullback of the smaller move, then great. You've got a confluence of indications that this is a decent level to buy in at the pullback. So obviously we've built up a bit of a framework here where you can see there's different techniques I'm using, support and resistance. So it's these, we did have this support here, which again, there was a 50% level there, so it's understandable why you might have bought into that level. But down here we have the old resistance, we have the fact that it was the 50 level, and we actually have two Fibonacci's, one of which is the 61.8 of the smaller move, and one of which is the 38 of the larger move. You can see, so starting to build a bit of a case for why this might be a decent level to buy in at. And then number 4 on the list, we can see that we've got the moving averages. So one aspect of the moving averages is that it's good for just denoting the kind of environment that you're in. So in this, well, the simple rule of thumb that I and many traders have is that while the shorter term period moving average is above, the longer term, you're in a generally uptrending environment. Now, obviously, you have to factor in the fact that we said, we're in this kind of choppy downwards environment, and there's all sorts of weirdness going on with moving averages over there. But maybe at this point in time, at the very least, you can see these averages are kind of they're aligned in a kind of uptrending environment. But what they also work for is as an area of support and resistance, as a place to buy in pullbacks, to buy dips. And so you can see here, all these other factors meant that it never quite reached the moving average. But in this kind of choppy sideways environment that we're having, there the 50 worked. Then the trend really accelerated, and it barely even pulled back to the 20. And then by the time it did, it actually did dip through the 20. You can kind of see that it hovers around. It's a bit of a kind of false break. It's those previous factors that we were highlighting. 55 was the area that kind of drew in the bidders again. And then when we did finally start taking out this old high and start making higher highs again, once we pulled back, you can see that it was this old little resistance where the price pulled back to, but it was also actually pretty much the moving average that was the final little support down there before the price kind of rallied up again. And you can see further up here that it is this kind of 20-day, and you kind of pull back a bit further. It's that old support level which really kind of works for this pullback, because we're consolidating and more like, we haven't made a higher high here. We're kind of going sideways. So the support works, but it's actually just above this moving average. So sometimes you buy in at the moving average itself, or sometimes you have to make the judgment that actually maybe the moving average is where you'd place your stop loss as a kind of judgment. Well, if the price moves below the moving average, for me, at least in the time being, it would denote that the trend is no longer up. And then the last one, but least, I wanted to kind of show you here, particularly in this kind of initial bit of price action, was Trendlines. And there's a broader point that I wanted to mention when doing this, which is something that can be really difficult to get your head around. The beauty of, obviously I'm highlighting pullbacks to specific price levels, and I'm sort of talking from an idea that, oh, wouldn't it be great if you bought at exactly that price level? But it doesn't have to be that precise. So just take, for example, we draw in this little trend line here. So the general rule of trend lines is that you need 3 touches for it to be valid. So, 1, 2, not quite a touch there, but you can see that actually this time it did work. So for an uptrend, you're connecting the lows. A downtrend, you're connecting the highs. I already did that downtrend line over there. That wasn't a really good one for a trending environment. But what I want to kind of draw your attention to was just this last occasion here. Has this trend line worked as an area to buy the pullback? So that's the question, right? What's your immediate answer? You're saying, no, it hasn't worked for buying the pullback because it's dropped through the trend line, so it wasn't a good place to buy. I would say that's the wrong answer if that was your immediate thought. Why? Because what's the general rule for where you're placing your stop loss? And this is something I'm going to allude to slightly later in the presentation. I realize I'm kind of draggy on a bit with this one. I'll try and speed up a little bit. But as long as you've placed your stop loss below the previous swing down here, so the logic being you're making higher highs and higher lows, right? So if the pullback comes down and makes a lower low, okay, maybe it's not an uptrend, maybe you don't want to be buying. That would be a sensible place to put your stop loss, down here below that previous low. But if you've bought at the trend line, the price dips a little bit further down. In this case, it finds support at the 50-day moving average. I've used the 20 and the 50-day moving averages. They're quite common. Typically, people use the 20, 50, 100, 200. Generally, the sort of round number moving averages people tend to use. But as long as it hasn't got your stop loss, basically your idea is that you're buying the dip. And so you may have bought the dip at the 50%, You may have bought it at the 61.8%. You may even have bought it up higher up here at the 31.8%. As long as you have your stop loss below the previous low, well, okay, you have to ride out a little period of loss, but as long as you stick to your convictions and keep your stop loss in place and keep the trade open, eventually you're right. So in essence, the fact that you've correctly judged the direction of the market, that there's an uptrend in place, was the key reason your trade worked out, not the fact that you've picked out a perfect place for the pullback. So that's a pretty key point. The main reason why you want to try and be as precise as you can in your entry on the pullback is obviously the lower you can buy it down, the less risk you need to take in terms of the size of your stop loss. Now, I hope that idea makes sense, but it's such a key one because it's so tempting to just think, oh, I wish I could buy exactly, it becomes that you forget what your purpose is. Is your purpose to be the perfect analyst who can perfectly pinpoint the dips, or is your purpose just to make money in trading? Actually it's to make money trading, right? So you don't need to pick the perfect spot. You just need to have managed your risk and be in the trade to ride out what becomes an uptrend. All right, I'm going to switch gears back to the presentation here. So the other question now is, okay, say you've got an idea where the pullback is about to end or is ending. How do you actually enter the trade? Well, for me, there are two main choices. What I would call a blind entry or waiting for a confirmation. So quick one on the blind entry. That's basically entering the market as soon as the price reaches the level where you expected the pullback to end. So typically you would place a limit order. So in the evening, you're looking at identifying the uptrend and you're expecting a dip at some point the next day. You place a limit order in the evening or maybe early in the morning before the trading day starts. You see an uptrend, you put in a limit order to buy. You see a downtrend, you put a limit order to sell at some area you think the market will bounce to. Or if you are more available during the day, at the very least, what you can do is press a price alert, and then you get an alert on your phone or your email, check the market, and then place a market order at your level. So as long as the market hasn't, so the benefit of B obviously is that the market may be completely collapsing and your analysis may be immediately obviously wrong, and you can avoid that entry. Well, obviously the limit order, if the market collapses while your order's in, you're going to be in the trade come what may. Obviously the advantage of A is that it just instills a bit of discipline. Your analysis says this is where the dip ends, you're prepared to risk this much, okay, just place the trade and come what may. The second option, waiting for a confirmation, is where, okay, the level has been hit, but you want some signs that the market agrees with you first that that level is the correct one to buy the dip. Now, the downside here being that basically confirmation means the market moving in your favor, which necessarily means you buying at a higher price or selling at a lower price. But obviously you get that extra comfort factor from the signs that the market's already bounced a little bit or already kind of dropped off a little bit from the sell points. So it's nice to have your idea confirmed, but you just have to pay for it. That's the idea. So two obvious examples would be candlestick patterns or just lower time frame trend reversals. Now you just jump back to the trading platform to kind of show you these ideas. So if we can pull back, so again, guys, I appreciate that. I mean, it didn't take me a lot of planning to kind of, I mean, this is just the most recent market action we've had. I mean, this is the oil market as it currently stands. This was just the beginning of a trend. I'm looking at this old bit of market. I don't know why I necessarily am. I could be looking at a more recent part of the market. It's just that this particular, it looks like the market's rolling over into a bigger correction phase, or a kind of complete reversal at the moment. So it's not, this to me is not such quite a clean dip buying environment as this was. But if we can pick out, for example, here, if we saw the market break above this level and we wanted to buy at the old high, when we had this particular candlestick pattern, where the market tried to sell off, ended up closing very near its open, then that was a little indication, and people call this little pattern multiple things, like a pin bar, for example. This is a popular candlestick pattern, a reversal candlestick pattern. So there's no big downtrend before this, but there is a correction before it. So depends how you want to use these things, but that to me is a little sign of a temporary, little small time period sign of strength on the chart that you're trading. So we're trading a daily price chart here, and we've got a daily candlestick pattern. And the other thing that I said was that on a shorter time period, you can have a kind of change of trend. So if I can do, maybe I can cheat a little bit, do that. How far am I going back here? Maybe 4 hours is better. So now the idea is that, okay, we're on a 4-hour chart. We've kind of based our ideal entry somewhere off this daily chart level. But what we want to see is on this shorter time frame where the market, you can see, is making a lower low, lower high, lower low. We want to see this sort of short time period, which I think would have been better demonstrated on the 1-hour chart. Can I actually do, no, it just keeps going to the most recent price action. Pain. But the idea is that if you did dip to down, for example, a 1-hour time period, but you can still see it on this 4-hour time period, then in fact there is a little downtrending period, and what you want is something like a trend line break, or for example, I don't know if this is going to necessarily show it, definitely the 1 hour would be better, some sort of oscillator, for example. So I chuck in the stochastic. Yeah, it's like I thought, it's not ideal, but nonetheless, we've got drawn in the 20 level as the bottom of stochastic, but if you are using the 30, you can see, actually no, I suppose actually on this particular time period, you can see basically the market got oversold and then bounced up. On a short time period, the market got oversold off your level that you were looking for, and then it kind of rallies up, and the market kind of gets out of its oversold condition. This short-term trend reverses, and it goes back in line with that longer-term uptrend that you were buying the bounce on. So rather than buying it right down here, maybe on the money at 53, or we said, what was our level was this. A nice example is that it's pulled back through our level, but then it's rallied up through our level on the short term, broken its short-term trend, and then the market starts rallying again, and we wait for this move up here somewhere to buy in. And then typically what you'll do, as I mentioned on this next slide, in terms of a stop loss, when you're using a price pattern or an indicator as a short-term indication as a confirmation, you just put your stop loss behind that most recent price pattern, because you're buying higher. You can't really put it at the beginning of the last leg, and you can put it a set distance beyond the level being traded, but this is the logical one when you're using a confirmation, that 0.3. So just to talk quickly about these stop losses again, if we jump back to the chart, it's back to that same concept that I used with the trend line. You basically ideally want to put your stop loss where the first leg started. So say this is the leg we're concentrating on, waiting for a pullback of it. You ideally want your stop loss down here somewhere. So again, if the market drops through that at the beginning of that leg, it's made a lower low, so that is in fact not an uptrend where you'd want to be buying. You can use a fixed level, a fixed number of points. So say you were looking to buy at 50, you'd guessed it perfectly. you know, maybe you just choose your stop loss down at 49 or 48, you know, some fixed number of points below the level that you're buying at. Obviously, the more points you use, the more risk you're taking, but the greater your chance has of eventually working out, because it's got more wiggle room if you have that larger stop loss. So fixed points below the previous low, or in the case of, you know, you're waiting for, you know, like for example here, there's another candle pattern. You know, if you're buying off this trend line, you know, obviously if you'd bought on a blind entry, you'd have to ride out this move lower. Whereas if you were watching the trend line and you realized it wasn't really working, the market was closing below it, but then you get this big bullish engulfing candlestick back above the trend line, you know, then maybe you'd buy back up here and have your stop loss just below that dip where the candlestick pattern happened. So I've been starting using this slide more often, just as a reminder. It's good every time. How to start using these pullbacks? Well, again, you know, don't trust everything I'm saying. Have a look back through. I could only really find the last trending market to try and demonstrate these points. But if you have a look through the markets that you trade and the time frames that you trade, have a look what works. Do some kind of practice paper trades, and then if it seems good, obviously do some forward testing on your demo and then your live account. Thank you very much for attending, everyone. I hope that was of some use and you learned a little bit more about trading pullbacks today. And if you did enjoy this video, please subscribe to us on YouTube and make sure to tune in to the next live webinar. We're live every Monday for market analysis and during the week for more educational topics. Thanks, everyone. Have a good rest of the trading week.